There's major risk taking in the financial system today. Much enthusiasm has kept this bubble going, but of course, we have seen what low interest rates for such a long period of time can do to the psychology of the investor. No doubt, more risk will push investors beyond what is sensible and as a result, off the edge. How many will be prepared when the time comes? Not very many, that's for sure. You came here for the truth, so let me unveil that for you. Today, we are going to talk about how we've gone beyond 2008. The financial crisis was supposed to have taught us a lesson or two, but the vast majority of people have forgotten entirely. When you take on too much risk, whether that's at the corporate level or the personal level or the national level, you get burned. Today, we are going to look at many factors. I've got a lot to cover and not much time to waste. Let's go. I wanted to start with this because this is the sentiment that we are seeing on all levels, whether it's the financial analysts, whether it's the politicians, whether it's the supranational entities. Here we have it. America's financial titans are coming to a consensus. We are on the early edge of the biggest economic boom since the 1940s, with the promise of years of growth. Years of growth. That's right. Everything is going to be fine simply because there is, I should say, a contraction, and following that, of course, an expansion. You've got stimulus measures on all levels coming in from every angle, and this is going to be the solution. But if you stay here until the charts I show you at the end, you will realize that that is not true. You cannot create wealth. You cannot create stuff by printing money. You will always make it worse for the bottom 50%. And in fact, the vast majority of people, everybody except the 0.001% or probably higher are going to benefit from these activities today. And quite frankly, that is something that they just do throughout the cycles. If you watch the cycles and how they take place, there are always people who, when they fall down, are never able to get back up. And if you make this more exaggerated as time goes on, as we have seen, there are more and more people who cannot handle the ride. Still today, you have approximately 18 million people who are getting some sort of unemployment insurance, emergency claims, and so on. 18 million people. And this tells you that you've got a situation that is not necessarily what they tell you. They give you this the last time I checked anyway, 6.2% on the unemployment rate. And just look, it's been floating around this area for quite a while. 18 million people. That doesn't include the 40 plus million on food stamps. That doesn't include how many people had their pay slashed and never got it back to what it was before. Those individuals who are getting part-time and not really working their full-time hours. Even Jerome Powell himself has said the unemployment rate, the real unemployment rate, is closer to 10%. The job situation is dismal. You've got people who want to be working who are not, and they do not end up on the statistics. And somebody has to speak for this group, and I will do that. And people need to learn why this is important. Because again, when you create stimulus and you give it to these people, sure, that might help them today, but it doesn't create growth for tomorrow. You take from tomorrow to bring it into today as a survival mechanism, but that doesn't do anything beneficial in the long term. This right here is huge. It's massive, and I need to bring it to you. Yes, it's about Canada, but understand that it's basically all over the place, okay? The amount of leverage, the amount of margin, the amount of debt on all levels today, whether we look at the stock market, whether we're looking at housing, whether we're looking at anything, it's going overboard. And that's my whole point. But I'm using this as simply a prop. Canadian mortgage approvals for, quote, this is their quote, over-leveraged borrowers soars to a record high. take a look at this information here. Let me zoom in if I can. Canada's banking regulator is seeing a spike in highly indebted mortgage borrowers. They observed that the renewed growth in the exposure of mortgages to over-leveraged households in the fourth quarter of 2020. Low interest rates are fueling rapid growth in borrowing for both quantity and size. The share of mortgages going to over-leveraged borrowers blew past the pre-B20 highs. It now sits at the highest share of originations on record. They give you the percentages here. I don't want to bore you, but of course, 4.5 times the borrower's income. That's what they say. And they want that lower, but of course, that's not what's happening today. And look at what's going on with the prices. And they have to push this as high as it can get. I will show you right here what the chart looks like. And to me, it's very clear. They changed, the guidelines here, and why? Because, they have to create a bubble. The risk taking today is going on with not just with their permission, but with their encouragement. All they have to do is bring interest rates up just a couple notches. I'm not saying bring it back to where it was in 1980. I'm not saying that at all. I'm saying that when you tell the world that you're not going to bring up interest rates, it's the same in Canada as it is in the US. All the way through 2023 is their forward guidance. We're not going to touch interest rates. Why wouldn't people borrow the maximum amount of money and simply ride? That's what they're doing. But the difference here between Canada and the US, in Canada, every so often you have to refinance your property. That's the way it works. So perhaps 5 years is the average. So every 5 years, let's say in the next 5 years, people will take a home today, 2026. What are interest rates going to be then? Okay, so they're paying $2,000 on the mortgage today, absolutely affordable for them because they make this much money in that. But what happens in that 5-year period to interest rates? Are interest rates going to be higher in 5 years? Well, can they go down from this point? Five years additionally of these interest rates and this bubble, it would be something spectacular. It would be, beyond imagination. It wouldn't be possible. It could be going sideways, but certainly not 5 years of 30% year-over-year gains. It is truly a disservice to the average person. But the average person isn't going to complain because why? Their retirement account, their house, it's going up in value. They feel rich, but they don't realize the consequences. Home prices soar in frenzied U.S. market drained of supply. Almost half of properties have offers accepted within a week. Flexible work options, rate urgency help fuel buyer demand. What I wanted to point out here, if you go to the actual bottom of the article, basically what it said was there's an example of somebody way overpaying. They knew that. They admitted that. They took off all of the contingencies. Well, don't worry about the financing. Don't worry about the inspection. We are going to take all the risk. They basically pull all the stops. There are examples here that they send letters to try to get in. They use examples in here of people literally just giving money and saying, accept our offer, or just take the offer. And there's so many things that are happening today. And one of the activities that I'm noticing is, for example, they price a home at what I'm noticing a lot, actually. I think it's something like this. They price it at 1.09 million and the actual homes will sell for 1.6 million or so. They do this, they're all now doing this together in concert, the real estate agents, where it goes for this price purposely because you're not exactly, when the house is priced reasonably close to the asking price, you're going to have some obvious variances there depending on the situation, but you can kind of estimate where the selling price is going to be. But when it's this far off, you're looking at like $500,000, it's hard to dictate. So what does the person do? They start offering 1.7, they start offering 1.8 and so on, because they know there's such a limited supply. The only way to guarantee it is to take off all the contingencies. Don't worry. Oh yeah, you have foundation problems? Well, I'll find out about that later on. And you've got to offer a much higher price than anybody else would. This today is a dangerous game. Here's the 30-year fixed rate mortgage in the US. It has come up quite a bit, almost suspiciously since the very beginning of 2021. It has been rising, and currently, as of this recording, it's at approximately 3.13%. New York City's ultra-high earners will soon have to pay a top marginal income tax rate of nearly 52%, the highest personal income tax in the US. I honestly don't know how many are going to stay. More than half of their income goes to the government. That doesn't include sales tax. That doesn't include their property tax. That doesn't include all the other taxes these people have to pay. Okay, so they're making $1 million a year. Now that's 500,000, shrinking down even further. I'm not saying that they're starving. Please don't get me wrong, but I can't see a lot of these people sticking around. And then all the tax dollars are going to be put onto the middle class. This is unfortunate when they think that simply increasing taxation is going to fill the void. It can't be filled. If you look into it and you take a look at actual math, it is impossible to pay what they need to. This article here talking about the same situation. Many of those New Yorkers are looking to Florida as a way out. Fantastic article here out of Bloomberg. It really gets into a lot of depth talking about the bond market, a hidden bond market problem. American savers could once count on bonds to provide meaningful returns with modest risk. Not anymore. So essentially, they were talking about a pool of safe debt. Previously, you can get 5% or more in these so-called safe guaranteed safe investments. You go down, you take a look at what it looked like prior to the 2008 financial crisis. So that lighter blue color, that's a AAA rating. And when you get down to the darker purples, that's BB. Okay, so you look at, when you get to the close to the, the junk and all this stuff. Then you scroll down, and by 2019, you could see how it really, really changes. And there's a lot more dark purple and not that many of that light blue color. And, just showing you as you move through how this shrinking pool becomes a problem, forcing investors to go into a different direction. Now, I personally am not a big fan of what they call guaranteed payouts on these bonds. Argentina bond, the 100-year bond. I mean, is that a guarantee? Well, it's guaranteed by that government, but of course, they'll probably just default on it. You know that. And you look at all the other examples. How can you justify giving up your money for that long period of time with no risk? So what are investors doing today? They're going to equities. That's the number one thing. They're going and they're moving their money into other things altogether. You see cryptocurrencies rising, $2 trillion market cap approximately. You see all of these other new creations that didn't exist before. Why? Because of the search for yield. That is extremely, extremely relevant. But I want to show you what's on the chart here. The average yield across bonds rated BB and lower recently fell to a record low. So even when you take a higher risk in this towards that level of junk area that I always talk about, that I warn about, this is really netting very little. So what do? Do you go even more junk and more junk? That seems to be happening. And for those who have stuck around, I want to show you this, because this is what I talked about at the beginning, and I'm bringing you around to that. Understand that the money GPS might be wild. You might think you're just getting one individual thing, but there's always a method to my madness. Now, the delivery, that could be a different story sometime. Anyway, as discussed previously, while the next American Rescue Plan will be roughly the same size as the original CARES Act, its impact in the economy will be less. And that spike up there is just showing you essentially what it looks like for the CARES Act. And that's the legend at the bottom, if you care to see it, quarterly change. And then you're looking at the federal government current expenditures, basically just trying to show you that the output as a result of what they had pumped into the system from these different stimulus packages, as time moves on, it gets less and less. GDP quarterly real change at an annual rate plus Fed expenditures. That orange, those orange parts of the graph, that's just showing you the Fed's expenditures, the federal government's expenditures. And then you have the purple, which is the GDP at annual real in billions of dollars. Essentially, same thing. They pump in more money, you get less out at the end. I hope I made myself clear on that. Fiscal policy dumps and relative GDP growth. You could just see that the stimulus bills, CARES Act, HEROES Act, American Rescue Plan, the GDP growth on the other end simply doesn't cut it. Not a good buy. $5 of debt to $1 of GDP growth. It is quite unbelievable to see how far they have gone and yet where they're taking everyone along with it. That's all for this video. If you found it informative, hit that thumbs up button. I just sent an email right before I recorded this to Nomad Capitalist, Andrew Henderson. I want to get him on the channel. I want to start doing interviews here. Not all the time, but on occasion. I'm going to make some changes here at the Money GPS. I hope you support me with them. We're going to go in all different directions. I want to take it bigger. I want to make it better, and I want you behind me. So I really do appreciate that. I sent him an email. We'll see how that goes, and that might be the start of something bigger. If you want to learn about e-commerce for free, I created a course for you, my subscriber, and you can check it out at theamazongps.com. I've got 2 books that you have to read if you want to know the foundational principles, how to make money, reducing debt, all here in these 2. Check the link in the description. Have you seen this before? If not, highly recommend it. Check it out, click it, and I'll see you there.